So let's talk about some of the key expenses to track. So this is very important because oftentimes I see clients miss out on so many expenses. Okay, and so that's why this is important to track, particularly when they're buying properties for the first time. There are so many expenses that people don't realize that they need to track. Right? If you're buying a pre-construction condo, for example, you need to look at your statement of adjustments because there are lots of expenses that are embedded in those statements. You need to be able to track those. If you're closing on a regular property, you need to look at your closing statements because there are expenses there that needs to be tracked. Right, things like your land transfer tax or your legal fees that you're paying, title insurance fees, all of these things would need to be tracked. Oftentimes, it's easy for clients to miss things like this. So always pay attention to those things. Now, I'm going to break down the main expenses into two categories. One, the regular expenses that we can deduct on a yearly basis for our tax returns against our income to determine our taxable income. In terms of regular expenses, we have things like advertising, right? You probably pay advertising sometime to get a tenant inside your unit. We have insurance. We have interest, and this may be our mortgage interest or interest on the line of credit we use as part of our down payment, or interest on any private loan. Then we have bank charges. If we have bank that we're using specifically for our rental operation, there may be bank charges that we need to capture. We may have office expenses, right? So these will be regular things like your printing, if you're renting an office space, if you're working from home, right? So you may be able to deduct your work from home space as an expense. Professional fees, right, including legal fees, accounting fee, management and admin fees. Okay, so sometimes if you have a condo, that condo expense may come under this category. You may have other routine repairs and maintenance, things like getting a cleaner to get there to clean your property, having some quick plumbing repairs that you need to fix. Um, all these regular routine expenses are things that you can put under this category as well. Property taxes, travel expenses. So let's say you're going back and forth from your property to collect rent, to do property inspection, you can actually deduct your cost for that travel. Then utilities. If utilities is something you're paying that you're not passing on to your tenants, then obviously you can deduct that as an expense. Now, the other category of expenses is what we call capital expenses. Okay, a good example for this one is the cost of your property. So if I spend $1 million to buy a house, then that $1 million I can deduct, but I cannot deduct it as a regular expense. I have to capitalize it and deduct it using what we call amortization or depreciation. Okay, and that's what I can do over a number of years. So in Canada, CRA allows us to deduct 4% of the cost of the property every year as amortization expense. And CRA, they call it capital cost allowance. Okay, it's all the same thing. Either capital cost allowance, when you look at your tax return, that's what you see. On a regular financial statements, we have it as amortization or depreciation. You may also have major repairs, okay? And these are repairs typically that will extend the life of the property, or repairs that typically have a benefit that exceed more than 1 year. So a good example is if I replace my laundry machines. Okay, I know my laundry machines will typically last me anywhere from 5 to 10 years. Okay, so that becomes a capital expense. So if I spend $5,000 to get new laundry equipment or machines, then I cannot deduct that $5,000 right away. Okay, I can take that $5,000 and deduct $1,000 every year for the next 5 years. Okay, so that's a capital expenditure. If I replace my roof, okay, I know the roof will last me multiple years, maybe 10 years. I can take the cost of that roof and deduct it over 10 years. Okay, so all these major expenses or major cost of appliances and equipment are things that will capitalize and deduct over time. Closing cost. Okay, so if you look at your statement of adjustments, if you look at your closing statement from your lawyer, all those costs incurred to buy the real estate cannot be deducted right away. Okay, so these are costs you have to amortize typically over 5 years. Okay, so costs like your land transfer tax, legal fees, financing fees, all of these closing costs together, you can amortize them and deduct them over 5 years. Okay, now in general, any expenses incurred to earn rental income can be deducted. Okay, so whether those expenses were listed on this slide or not here, so long as you incur an expense to earn rental income, then that expense is eligible for deduction for tax purposes. Okay, so there has to be a cause and effect relationship. In other words, the expense has to be directly related to me generating rental income from that property. Okay, and again, for all these expenses, it is important that you maintain records. So that means you're maintaining your receipts. You're making sure that the receipts are in your name or in the name of the corporation that owns the property. You're making sure that you're maintaining record of how you paid for these expenses, because if CRA audits you or requests for additional information, that is what they want to see. They want to see those records, and they want to make sure that those records can directly be linked to the property. Okay, and then secondly, you should note that the principal repayment of your mortgage loan is not considered an expense. So anytime you make a mortgage payment, that mortgage payment includes two components. One is a principal portion, and secondly, there is an interest component. Okay, for tax purposes, we can only deduct the interest component. So anytime you get your mortgage or make a mortgage payment, you have to determine how much of that payment is interest and how much is principal. The principal repayment goes towards reducing your loan or your mortgage loan, and the interest, again, you can expense as a rental expense.